Good morning, ladies and gents, and welcome to the September 2025 edition of the Blackfinch 10-minute market forecast. We're pleased you can join us today. My name is Jordan Kent, Distribution and Sales Executive for Blackfinch Asset Management, and my co-host today is Mr. Josh Clayton, Listed Product Specialist for Blackfinch Group. If today happens to be your first time joining us, we use this webinar to bring you what we believe are the main headlines and markets, bring you up to speed with the big stories in the world of asset management. If you have any questions, then we'd love to hear from you. So please be our guest and use the Q&A box at the bottom of your screens. And we'll come back to you once we've concluded today's session, where I'll also share our contact details to reach us directly. Before we begin this morning's content, it's important I note that this presentation is intended for financial professionals only, and therefore should not be taken as financial advice. So we have three powerful forces shaping markets to cover for you today. First, we start with one of the biggest drivers behind this market cycle, the continuing spends in AI. Since the launch of ChatGPT, investor appetite has been heavily focused on the growth of AI infrastructure, with NVIDIA at the heart of that story as well. We'll look at how this theme continues to shape markets and why the sustainability of that growth is starting to matter now more than ever. Secondly, we'll be exploring how the Federal Reserve is managing its dual mandate of price stability and maximum employment in the United States. Here, we'll review how this focus is feeding into market expectations, especially as we look towards the policy decisions that are set to be made in September. And finally, we turn our attention to Europe, where France has once again found itself in the spotlight, with political uncertainty flaring up and the drag on broader Eurozone sentiment this has caused so far. So we'll dig deeper into what's going on here and what it could mean for investors moving forwards. So from AI staying power to the Fed's next move to whether European politics spill over into markets, these are the questions shaping the narrative, where each one on its own merit could move the dial, but together they raise the real question about where risk is building and where opportunity might still lie. So with today's scene set, I'll hand over to Josh to walk us through these three areas. Good morning, Josh.
Good morning, Jordan. Morning, everyone. Hope you've had a good summer break and let's get stuck in today's content. So as always, Jordan's nicely summarized our three key themes on the screen here, and I'm sure you can be able to guess that main driver of the first bullet point is, of course, AI and more specifically, NVIDIA. So before I dig into the charts, as many of you know, AI has been this dominant earnings and capex driver pretty much since the start of ChatGPT in 22. And this has been one of the key themes that continues to propel the US market past all times highs, and with so many investors focused on the potential applications and profit drivers that some are almost ignoring other economic indicators blinking at them. And for some context, NVIDIA, the company is essentially the brains behind that modern computing story, with the main product being the GPU that was originally built to make games look better and run faster. And it turns out these chips are excellent at handling huge amounts of calculations in parallel, and that's great for AI uses and data centers and so on. So since ChatGPT, it's become less about gaming, more about infrastructure and AI and advanced computing, and its growth really has been undeniable. But the real concern has become more about the sustainability of revenues and profits rather than the trajectory of its share price. And this has become the real risk against a lot of the growth in the US. It's AI hype versus reality. Corporates are buying these chips at a record pace, but if your AI deployments doesn't actually improve your efficiencies or profit margins, spending can slow and valuations suddenly look very stretched. And that brings us on to NVIDIA's earnings releases. As always, they're highly influential for markets. It continues to be the case now. And last week, they again beat expectations. It was roughly about $47 billion in revenue for the quarter. The Blackwell data center revenue was up about 17% as well. However, even with such great numbers, the share price fell by about 3.5% in after hours trading, and that's roughly equating to $140 billion, which is enough to buy Spotify or Pfizer. But that really doesn't make a dent in this left-hand chart on the screen here. This just shows the trajectory of NVIDIA's market cap over recent years. And in 25, it's taking over the total valuations of the UK, French, German main stock indices, as well as the S&P 500's energy sector. But as I've said, the Nvidia narrative continues to be about its phenomenal success at selling these chips at good profit. And the right-hand chart compares the growth of sales and earnings for the company against the S&P 500 as a whole over the last decade. We know that this can't carry on, and this is what investors are looking out for. And this talks to some of the volatility in the share price and the wider market. But for the moment, Nvidia continues to post impressive results. It's still highly influencing the wider US market, but we're starting to see a slowdown, and the next step is to see what happens with these chips. But in our view, while this thing continues to play through and US company earnings remain relatively robust, we could see this recent rise in valuations be sustained at these higher levels, unless something material happens in the US economy. And that brings us on to the second slide with what's going on with the Federal Reserve. Now, this next slide really is it's the meat of what's going on in the US. And as a brief reminder, the Fed is slightly different to the Bank of England with regards to its mandate, in that rather than just having a price stability focus like most central banks do, so that 2% inflation target, it also targets maximum employment, and that's a nice and healthy jobs market. And it's precisely that dual mandate that investors have been focusing on recently. The Federal Reserve has a responsibility to both objectives, and it's actually been the jobs market that's been flashing to the Fed recently. And this was talked about by Powell at the Jackson Hole Symposium. So this symposium happens every August, and it's essentially where central bankers and economists get together in Jackson Hole, Wyoming. And it's often where the Fed lays down those big picture policy shifts. And it's been very famous in the past with the likes of Ben Bernanke and signaling QE in 2010, and Powell shifting to average inflation targeting in 2020. So markets listen very carefully to these addresses, and the employment chart on the left-hand side paints one version of the US job market. Now, there are two lines on the chart. The red is what's known as a labour market differential, and it's just a survey conducted by Oxford Economics that asks people whether they feel jobs are plentiful in the US and subtract it from those saying jobs are hard to get. The axis on the left is inverted, so if the red line ticks up, fewer people are saying there's plentiful jobs and are instead saying they're much harder to get. And this red line is very much forward-looking survey data. It can give us an idea of what's to come. And then the blue line is that typical US unemployment rate, and ignore the COVID skew that's thrown some of the data. But we can see over recent months, there's an upward trend in red, and it hasn't yet fed through into the unemployment rate. And if you want to understand more on that, look at our last webinar where I go into some detail here. But this chart is one of many that's starting to show a weakness in the labour market. And at Jackson Hole, Jerome Powell was quick to address it. So he hinted towards a September rate cut, and I'm paraphrasing here, but it was to do with a shifting of the balance of risks. And that's almost a very strong hat tip to a weakening labour market. So even though inflation like CPI and PCE have been trending upward, Powell is still suggesting a cut. And this talks to this conflict in the dual mandate where jobs are winning out here. And this is what the right-hand chart is showing. It's just a measure of the swaps market. It's a tool that many use to price forecasted interest rate adjustments. And we can see a day after the address, there's a material step down in forecasted interest rates. And this really did help US markets climb further in August. We also believe it could be supportive for equities, despite some already rich valuations in the US. And in this kind of environment, we could see the more interest rate sensitive securities perform well. We've seen our own US small cap fund used in our portfolios post solid results over August. And the range of outcomes still favour equities over the near term, providing there aren't any shocks that will change this. And finally, politics has very much been a factor to returns recently, but rather than the US, it's once again been France in the spotlight. And after about a 9-month respite, sadly, we've got to start talking about French politics again. It was before my time, but for those who were in markets during the Eurozone debt crisis, there have been faint echoes of this once again. The spreads on French bonds against the likes of like your German bonds is almost back to highs during last year's crisis, if you remember. And if you've checked markets recently, you would have seen the Eurozone give back some of its gains, especially if you're passively buying the market. And this chart just takes the French market, compares normalized performance since the start of January 24. And as we know, up until now, the bloc has given some very stellar returns for lots of different reasons, but France remains the concern and has been a material drag. We've seen President Emmanuel Macron's failed gamble on snap elections that turned into this three-way logjam in government. They do have some serious budget issues, and PM Michel Barnier resigned after a failed budget vote. And this is all just boiled into a no confidence vote set to start on the 8th. So, unfortunately, the outlook is still very uncertain. For the moment, the new PM has had a go at trying to push through a budget, and he wants to save roughly about 44 billion euros next year. But to do it, he wants to scrap bank holidays, curb social spending, to not increase 2026 pension payments and other things like this. And we just know that's almost going to be near impossible to get through, and certainly wouldn't fly in the UK, which leaves us to this no confidence vote and further knock-on implications for French investors. Thankfully, at the moment, the rest of Europe has been so stellar, it hasn't rocked the boat too much, but certainly some active management in Europe and steering away from a lot of French companies would be prudent, as we're likely to see this ongoing drift of political risk. So just a quick summary on what I've covered. First, recent trends like a Fed rate cut, maintained investor appetite could still be supportive for equities in our view for the rest of the year, but risks are very real. It will not take much to make investors cut back and take what profits they've made this year. So diversification absolutely remains important. For our portfolios, we remain regionally diverse. We hold the likes of emerging market equities, Asia Pacific, European equities, while still having some good exposure to the US. But we're also favoring high yield bonds at the moment. Despite some of these economic concerns, high yield bonds are offering some of the most attractive levels of income we've seen in over a decade, with particularly wide credit spreads. And they're well above both government and investment grade bonds. And I think the important and key point to this is default rates on these bonds remain very, very low. And that's thanks to a much healthier corporate position and balance sheets for these companies. So we do believe it's very prudent to access these at the moment to give us that better return profile. But Jordan, that's all to me. So I'll hand back over to you.
Thank you very much, Josh. And thank you everyone for joining us today. As promised, if you haven't submitted a question using the Q&A box yet, I'd like to ask us anything on the content we have or perhaps haven't covered today, please use the details on screen now for Josh and I, and we'll come back to you directly. But otherwise, that does conclude today's webinar. So we hope you found this session useful, and we hope you join us again in October's edition, set to take place on Tuesday the 7th at the same time of 8:50. So finally, from all of us here at Blackfinch, we hope you enjoy your day, and we look forward to speaking with you again very soon. Bye for now.